Good morning, everyone, and welcome back to our accounting series on Boardroom Forum Live. My name is Shreeya Jugnandan, an Associate Director at PwC's Corporate Reporting Services. Joining me today for our final episode is Renshia van Noordwyk, a partner in PwC's Corporate Reporting Services. Welcome to the show, Renshia.
Thank you, Shreeya.
Renshia is an IFRS 16, that's the standard dealing with leases, expert. She leads our global topic team in this regard, and she has a lot of insights to share with us on this particular accounting standard. Renshia, what I love about the leasing accounting standard is it is everywhere. It's in the shopping malls where retailers may be leasing sites at the mall. It's the parking lot. It's just down the road. It's absolutely everywhere. What a cross-contextual standard, Renshia.
Thanks for making the topic sound so exciting, Shreeya. But you're right. The leasing standard does cut across various industries. It's not industry specific. So even though you would expect only banks to be potentially affected where they provide financing for customers, it's not the only place where we see leases. We see it in the mining industry. We see it in the telcos industry, in the retail industry. So it definitely is all over the place.
It's powerful and pervasive. But speaking of the standard today, Renshia, I'm sure we're dusting off the covers of IFRS 16 because it's been around for some time. What's the latest movement in this accounting standard?
So why we're talking about the standard today is because there's a bit of refocus, I want to say, on the leasing standard. And the reason for that is that the International Accounting Standards Board, or the ISB, have embarked on their post-implementation review of the standard. So what does that entail? So normally after a new standard has been in issue for a couple of years, they need to take a look back and do an assessment of whether the standard is working as what they intended. But before we get everybody too excited that we're going to get a whole new leasing model coming through, a post-implementation review is not a whole new standard development session. It doesn't necessarily always result in standard setting by itself. It's really looking at, is there fundamentally, fatally flawed, wrong with the standard? So is there something that is really not working, is what they intended to be in the beginning when they issued the standard? So the purpose is just to be on the lookout to understand, is there potentially some changes coming through, but don't hold your breath that we're going to get a whole new model.
Not a whole new model. Renshia, what I like about the post-implementation review process is it's a chance for reflection. So maybe take us back a couple of years to remind us what was the ultimate objective of IFRS 16 when it was first introduced.
Good starting point. So let's go back to where the standard originated from. And the best way to probably summarize this is to go back to what I want to say almost famous quote by a former chairman of the board, Sir David Tweety, that made the comment to say that he wants to fly on a plane that is on the balance sheet of an airliner. Wow. And that's probably the best summary of where IFRS 16 came about. So before IFRS 16, just a reminder, we had the dual model for lessees. So you either had an on-balance sheet accounting, which was for finance leases, or you have what we call off-balance sheet accounting when it was classified as an operating lease. The users of financial statements felt that that is not a useful model. They need to make adjustments for this distinguishing factor between the two models. And therefore, the board had a stand-back look at it and said, well, they believe a single model is more appropriate and more user-friendly. And that's why we moved then to the IFRS 16 model we have today, that for lessees, almost all leases are on balance sheet.
There's a hidden alliteration in there, Renshia. We're bringing the Boeing on balance sheet with IFRS 16.
There we go.
So what about the lessors in this conversation? Because we focused a bit on lessees thus far.
Good question. So when the board deliberated on the IFRS 16 principles, they did have the question whether the same single model should be replicated for the lessor side. When they did their outreach, the feedback that they got was that from a lessor perspective, they don't believe the model is really broken. And the reason being, if you think about the lessor, they will have an asset on balance sheet either way. So if it's a finance lease, they will have the net investment in the lease asset. If it's an operating lease, they will continue to recognize the physical asset on balance sheet. So they do not believe that there's such a fundamental flaw with the lessor model. And they also did an outreach and assessment and believed that a cost-benefit analysis resulted in them leaving the status quo and accepting the lessor model as is. So they made small changes to improve it a little bit, but not wholesale changes on the lessor side.
So we've done a bit of a reflection. We've thought about the purpose of the standard. We thought a bit about lessees. We thought about lessors. Let's bring ourselves back to the present. Renshia, I'm sure your desk has IFRS 16 questions on it every day. There's never any dust on that desk. So what's been on the board's mind from a big picture perspective? What's topical in IFRS 16 land today?
So maybe we can think about the beginning of the standard, and that's starting with the scope.
Yeah.
If we think about the scope of the standard from a local perspective, what are some of the tension areas that we are debating? Just taking the step back, if you think about for lessees, almost all leases be on balance sheet, what would be your first starting point is, am I in the scope of the standard to start off with? So do I need to account for this under this as a lease contract? And more recently, what are some of the contentions matters we're dealing with from a scoping perspective is, for example, our power purchase agreements that we see locally. And you might think, but I'm purchasing power, I'm thinking about the lease contract, and not necessarily every contract is called a lease that is a lease or contains a lease. In a lot of these contracts, there is a specific asset that's used to provide the end product, being electricity, to a customer. And in those assessments, it could result in these arrangements either being a lease or containing a lease.
We just started off this conversation by saying leases are everywhere. They truly are hidden. So something doesn't have to be called a lease to present as a lease under IFRS 16. So it transcends almost the legal nomenclature sitting in that contract. So in substance, lease is something to watch out for.
Exactly.
Particularly topical as entities transition into a greener economy, employing these power purchase arrangements. Renshia, what else has crossed your desk? Anything from a lease term perspective? I know that's an area people tend to struggle with quite a bit in implementing the leasing standard.
Yes, so your next step in the assessment is then, once I've assessed that I am in the scope of the standard, for how long do I now need to account for the asset and liability on balance sheet from a lessee's perspective? So that then puts a lot of tension in terms of the lease term and assessing the lease term. What is a further complication or something to think of is that the standard does allow a practical expedient to say any lease contracts that has a lease term of less than 12 months, you have the practical expedient of not accounting for that on balance sheet, but expense as incurred. So you can understand that there's then a bit of tension in terms of, I want to say, structuring lease contracts to have a shorter lease term, to not have this big asset or liability, and liability are then on balance sheet to account for. So there is a bit of tension and judgment then applied in assessing what is my lease term. How do I think about renewal options, termination options, etc., especially in what we call evergreen type arrangements where the contract just continues to renew itself until one of the parties decide to terminate. There was also then a question raised to the board in terms of how do you think about these termination options, because then it asks you to look at penalties in order to assess what is my lease term. And the question was, what are the penalties that we look at? Is it only financial penalties, or do we look broader? And the response that we got was that it's the broader economics. You need to look at the broader context. So if you've had, for example, significant leasehold improvements, that will play a role in the assessment of your lease term.
So always bear in mind the broader economics when it comes to thinking about the lease term. What was also conversational, I think, continuing this train of thought, is substitution rights.
Yes, exactly. So more recently, the board also had a question in terms of how to think about assets being substituted over the term of the lease. The example that they looked at was buses that made use of batteries, and these batteries were continuously being replaced at certain points or intervals within the lease term. And the question was whether that now is no longer a lease because there's substitution rights of the asset in the lease. And the response back was, no, you need to look at substitution rights has to be throughout the use of the contract or throughout the period of use, and not just at certain intervals. So even in those instances, you still get caught within the leasing standard.
Renshia, thus far in the conversation, I'm picking up a theme of tension between on-balance sheet and off-balance sheet. Does this extend to the concept of lease payments, which is another critical input into our leasing model?
Good catch, Shreeya. So yes, so again, within the leasing model, so even though we say that all leases or almost all leases are on balance sheet, there is a component that will not be on balance sheet, and that is what we call variable lease payments. So if we take a step back in terms of the measurement of our lease contracts from a lessee's perspective, we would measure what we call fixed payments. So that's where you have your normal monthly rental payments that will be taken into account in determining your lease liability. In addition, what will also be included is what we call lease payments that's based on an index or a rate. And that's where you have a lease that escalates, for example, with CPI on an annual basis. So those two lease payments are included in the measurement of your lease liability. What is not included is what we call variable lease payments. So if we go back to our power purchase agreement example, where we normally see these contracts where there's not a fixed payment or a guaranteed minimum payment, but what the customer ends up paying is just paying per megawatt of electricity being generated. So that would be an example of a variable lease payment that's fully variable. And in those instances, you don't account for it as what we call as you said, the on balance sheet. You would expense as incurred. So again, I think that there's now this judgment and tension in terms of when does a payment really in substance reflect a fixed payment, even though it's structured to be variable in nature. And that's where some of the debates and the intention comes through.
A lot of judgment then necessitated in doing that assessment, I can imagine.
Correct.
Let's continue the theme around business and translating what's happening in a business's economic reality into lease accounting. Renshia, often we see entities wanting to downsize or upsize their premises, for example, if I'm leasing an office. Any practical thoughts or tripping points when we're thinking about elements like that?
So that one of the first questions that you need to consider in those instances is whether you are in the lease modification guidance or just in a reassessment of your lease. So what's the distinguishing factor there is for it to be considered a lease modification, contractually your terms in your contract needs to change. So if you are just implementing clauses that were existing in your contract, that would be more considered a lease reassessment. Whereas if you are changing the terms of the contract, so you have potentially thought, I'm going to use this whole building for the next 5 years. Now something happens, I'm downsizing and I just want to use 2 floors out of the building. And I have to change my lease contract, that would be a lease modification. And there would be certain accounting implications of then following the lease modification route.
Thanks, Renshia, for injecting new life into an existing IFRS 16 accounting standard. Thank you for your time this morning.
Pleasure. Thanks, Shreeya.
We've covered a lot when it comes to IFRS 16, particularly in light of the post-implementation review. We've chatted about the ultimate objective of the accounting standard, as well as certain nuances when it comes to applying lease accounting. I hope you've enjoyed our Boardroom Forum live series on accounting just as much as I have. Stay tuned on the PwC LinkedIn page for further announcements for our next series.